Good morning, everybody. It's Wednesday, May 14th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you get any questions or comments, please feel free to drop us a line in the chat area. We'll be sure to get to it during the show. Quickly here, overnight markets had July corn down 2 1/4 at 440 1/4. July soybeans are up 2 1/2 at 1075. And July Chicago wheat was down 3 3/4 at 513 1/2. No export sales announcements here this morning, guys. So we'll jump right in. I guess highlights here this morning. Still looks like a pretty good window for weather. We should be continuing to make planning progress, through a majority of the belt. I know there's some exceptions out in the east, but for the majority of folks, I think we're getting some good progress done, and followed by some forecasted rain. So kind of a pretty good start here for what we've got in the ground. Big news, coming up tomorrow. The potential for Ukrainian-Russian meeting. Will Trump attend? Will Putin attend? A lot of things up in the air there. So certainly I think outside markets will be watching pretty closely to see what comes out of that deal. Also, news this morning, the administration pulled the sanctions on Syria. So I think there's quite a bit of Middle East deal making going on this trip. So it'll be interesting to see how this all affects Iran. I mean, it's a big puzzle, but a lot of things moving and shaking here. And last but not least, the tax bill passed House committee this morning, so it seems like it's still on the trajectory for a vote by next week. I know that Speaker Johnson is shooting for getting that past the House and on to the Senate. So they seem to be making good progress there as well. Good morning, guys. Dustin, I guess maybe give us a few thoughts here on what you're looking at here in the markets, and then we'll throw it around the room.
Thanks, Dan. Yep. A lot of optimism in the soy complex last couple of days, and a lot of negativity in the corn complex. We've hit a new high ratio again yesterday, and even in the overnight session, you're seeing that in old crop beans rising over corn. What do we make of that? I think that once that ball's already rolling, if we're at 83.5 million acres of beans or less, we've actually heard, just from some seed company data that they expect that the corn acres could even be above what they wrote down in March, based on sales. What does that mean if we are in need of a 52.5 national yield just to get to a 295 million bushel carryout? And I think the market's starting to realize that. I mean, I don't know how many times in my career in the last couple of decades that beans have ended up as an elevated ratio to corn at some point in the year, with the threat that China is really hard to kind of ration off China when that buying starts. And if that is the start of these trade talks, is that the Senate is talking about U.S. ag sales to China as part of the deal, I think beans, rightfully are standing to ground against corn for the moment. Corn still has a year to get through, though. It's not like we're abundant outside of the U.S. We certainly are talking about a 2 billion bushel carryout potential this year if we grow that 181 yield. I wouldn't necessarily discount corn as being in a bear market yet. We still have to go prove a crop. But between the real rising, which is generally supportive to the ratio, beans over corn, and just ongoing just setup that we've had for the year, and a surprise coming out of it that there's actually positive talks in U.S.-China trade talks. I'm interested to see if this little 2-day rally we've had in the ratio and in beans above these major moving averages can continue or not. Be interesting the rest of the week.
Sure. Ben, what's on your mind this morning?
I'm just looking around. We've seen basis firm up in the Western Corn Belt, which that was a lot of the impetus for the sell-off. It's very firm in the East, and we've done a lot of damage. I thought it was interesting yesterday that intraday July D's went to a carry and was able to finish back slightly positive on the day, and I think that's something that people will be watching. It's like Dustin said, we've got a long way to go, and outside of the outlier of having an absolutely bumper crop, there are I think some reasonably good possibilities in corn as well. Our report that we got was not bearish for corn. You could read into it and say demand numbers were a little bit high, but we also have a yield number that was high and higher than by 3 bushels of anything that we've ever produced. So I wouldn't start putting corn in the grave just yet. And we're anxiously awaiting to see what can happen from the new administration, to see what we can get done for some additional export demand, hopefully in corn and wheat. So.
And Justin, you you talk about it a lot, but as you look at corn, back here, new crops below 440 again this morning. Again, being on top of it, how all these things come together, and at some point you gotta look at protecting your insurance payments and the possibility of farm bill payments and all these things that are coming into play again. Seems like we've talked about it multiple times, but I guess that would be probably word to the wise here, as we're, as you continue to see corn act the way it does.
Yeah. I think a couple of things that just to add to Dustin's point on the ratio, and I apologize, I don't have a good chart. Maybe we could do it for tomorrow's, but if you just look at a big picture of, that ratio's history, and you go back to the early 2000s, again, this is a history lesson, but that ratio used to go from anywhere from, 4 to 2, really 4 to 2.2. And that's really narrowed down. It's, if you actually look at it, it's in a kind of a big wedge, with the low being, call it the very beginning of the ethanol boom, where we had to get, a substantial amount of acres to switch from beans to corn every single year for 5+ years. So you saw that ratio get down to like 1.8, 2006, 2007, when that that trend first started. And then, then if you add in South American production for soybeans really ramping up during that time frame, we really haven't seen the lows or the highs reach those levels since early 2000s. So we've actually been narrowing that range, more to like a 3.2 to 2.2 type ratio, because we've got the big demand base here for ethanol, and we've got the big crops in South America. So it seems like that's kind of narrowed that range somewhat. But the point being is that every time we tend to go towards the very low end of that range, within a year or 18 months, we kind of go back towards the high end of the range. And I think that's, if you look at the bean corn ratio, for example, we got low, bought the acres, and now we're really kind of back, call it mid ground or even lower mid ground, call it like 2.5 to 2.6 would be maybe kind of average. So I think we're just kind of getting back into where that.
The long-term chart up, just for your reference, Justin, if Jack, you can show it.
Okay.
No,
So
not,
you do it.
There it goes. Yep.
Yeah. So yeah, this is what I have on my screen too. Similar. So yeah, you can see just it's pretty normal for it to, discount beans too much or discount corn too much. But I think if you look at it as a history lesson of what's happened in that time frame, I think it makes a lot of sense. And you could say, that, or I could argue that, especially if we get some of these 45Z things passed, some of these biodiesel loopholes closed, that maybe that starts to favor a higher bean corn ratio,
right,
over time, just because that's a new demand base that we found a way to substitute used cooking oil, to the tune of billions of pounds per year during that time frame, and allowed us to drive. And we had, some other issues around the world and global. We've talked about this a lot. Excluding China, corn and wheat stocks relatively tight, are actually pretty tight. So yeah, I think the recent moves make a lot of sense. And depending on what happens here with some trade deals and with policy, which we should have some answers relatively soon, wouldn't surprise me like this year to see beans break out to the upside of that wedge, which is actually really friendly for corn as well, right? Because now you've just got two crops that kind of need acres. So
right, yeah. I was just going to point out too, these three circles, they all corresponded with bull markets for corn, right? 2011, 2012, 2019, we had a big dip in the ratio. We had 20 million acres per plant. and no one really understood that it was going to be 20 million prevent plant bean acres. Like they still planted corn because the price incentive. So this was the price incentive this year. We had the price incentive to plant corn, and that's what we were just talking about. Maybe some of the seed company data suggesting more corn acres. If we do hold 95 plus million corn acres all the way through planting and through those June reports, and the FSA data confirms that in August, and bean acres are only 83.5 million or less, what are we capable of if we only had a 50 bushel yield? Beans are much more inelastic, meaning we tend to have a harder time to ration that demand when those times come. At least in my experience, that's what it feels like. So I agree. The market doesn't really. It's just starting to price this in. It feels like, but we'll see.
Yeah, no, certainly. And also, the other thing that's kind of changed, and not to get too in the weeds here, but is the timing of the South American crops, right? So if you look at when the ratio was making the low, it was the strongest competition with South American new crop beans, right? A new record crop coming off the combine. At the same time, they're kind of running out of corn or that first crop corn goes to all domestic use. And the Safrinha second crop corn is what competes with us on the export market, right? So if you look at the timing of it, now you've got a big Safrinha crop getting ready to come online, which competes with our export market right now going into even new crop sales, where beans is kind of going the other way, right? It's getting tighter in South America for beans as it's getting more abundant for corn. And that's another seasonal that's changed over that, the length of this chart. So there's these new markets and these new things have kind of changed, kind of the timing and seasonals of this ratio. So just from that perspective alone, I think it makes sense, and then addition of what Dustin's saying with some currency moves and some other things.
Yeah.
And Justin, as it pertains to acreage too, I mean, with like the Dakotas being off to a good start and being able to plant, like, are they more inclined then to be aggressive on planting corn versus most years when they'll plant beans? Yeah.
So some of the things I'm hearing on the fertilizer sales is that those are also quite high. Mm-hmm. And a lot of that region being kind of the upper Northwest, Dakotas, Minnesota, areas that are quite a bit ahead of normal on planting. And remember that North Dakota, 50% of the time it's like planting corn to prevent plant payments.
Right.
Like they're notorious for having bad weather, prevent plant. But in years like this year, been a really good start. They're way ahead of normal. Prevent plant acres look to be small. Obviously something could change, but as of now, that's where we could be seeing, some of that growth of additional acres, in my opinion, of corn.
Okay.
Now, not the best yields, but, in a good year, maybe it's 160, 170, it's still bushels.
Yeah.
That would and if maybe be beans.
Yeah, exactly. If it's a tight bean year, you're not going to get those 30 to 40 bushel yield on beans. It's still a trade-off.
Mm-hmm. Yeah. So, I mean, that's the question. I think the report was definitely a bullish undertone. The weather's obviously just too good right now to, corn feels like it's stuck. And then you have which feels like, I agree, corn selling and soybean buying, and you've got liquidation of old crop corn, Safrinha coming online. So you've got probably a little too many headwinds to make the report bullish, but it's definitely an undertone that I think is worth noting that now, especially when you get down to the low end of the corn range, it's even more cheaply discounted, in my opinion, with what we saw in the report. So that's all I would say. Corn could be stuck in a range and keep chopping people up, and maybe it can't get below those levels, call it 430, unless we really get, yields seem like they're going higher. And that's where your effective floor on crop insurance and some of those things would obviously start going lower as well. So until that, I think it's hard to get much below there, and call it, you get through pollination. And it's like, wow, I think I'm going to be 10% above my APH. And all of a sudden my effective crop insurance floor is 10% lower. That would, obviously, I think the market reacts to that kind of data. So.
Sure. No, very good. Real quick, Ryland, yesterday we saw Choice finally top 350, which I know has been a kind of a big significant milestone there. And then interesting to see in hogs, the open interest sharply higher during the Goldman roll, which I think highlights the interest in the funds there. So I guess give us a few thoughts here this morning.
Yeah, so I mean, we just keep on hitting new benchmark prices in the cattle market and the beef market in general. I mean, there just hasn't been any bad news like we're talking about. I think the sentiment right now is that we're starting to get a little bit overbought. There's some technical indicators that are flashing signals for this, but what does that mean when we're hitting these benchmark prices? So I think the optimism is still there. Obviously, in both places, in cattle and hogs, we're likely to see a pretty steep increase in producer hedging up here, just because the market's allowing everybody to get a lot more security with these higher prices. So yeah, we saw a big jump in open interest. I think the funds are still adding to their long position. As of the previous week, they still weren't record long in either place, but starting to get a little bit closer on the cattle side. And we know that, the screwworm situation is still afoot. This is going to be a month-to-month issue that the market's just going to have to deal with. So we're going to see how it really kind of shapes up from here. I think it just exacerbates the situation that we're in, just from a tight kind of younger cattle supply standpoint, and if we're actually going to be able to see any real herd expansion on the July report. So I think all the good things to kind of keep in mind here, but wouldn't be surprised to see a setback here in the cattle side of things. It just kind of feels like we're going to draw out quite a bit of hedging, but we haven't seen any cash yet. Right now, the asking prices are at 224, 225 in the south. So we should start to see a glimpse of just what packers are willing to spend this week, especially with the lighter kills that we're seeing kind of bleed into the beef market. So that's where all the focus is going to be turned for right now. And on the hog side of things, it just kind of feels like we've got good prices and we've got good margins out forward. So, I mean, we put a hedge recommendation out in the letter last night, especially for July and August. So just good levels here pretty much across the board. And I think it's one the producer kind of needs to take advantage of, especially at this time of year where everything's good and, all systems go.
Very good. Appreciate the update there, Ryland. And as always, if anybody's got any questions pertaining to those hedge recommendations or any thoughts like that, give us a call. We'd love to visit with you. Get a quick rundown of the markets here. We just opened July corn down 2 1/4, 440 1/4. July soybeans are about unchanged, 1072 3/4, and July Chicago wheat's down 3 3/4 at 513 1/2. A couple administrative points here this morning. We got it's the last day for May futures. So May grain futures go off here today. Tomorrow morning, we will have weekly export sales, 7:30 Central. So we'll take a look at those, visit about that in the war room. Also, NOPA crush out tomorrow, looking for a number close to 184.6. So that'll be out mid-morning tomorrow. We'll talk about that on Friday. Appreciate everybody that tunes in on a daily basis. If you wouldn't mind, throw us a like and certainly subscribe. Doesn't cost you anything to do so. It'll keep you up to speed on everything that's going on with the AgYield. So again, thanks to everybody that supports the show. We're doing this live every day that the markets are open on X, Facebook Live, and YouTube Live, 8:15 Central Time. Appreciate the thoughts and comments here this morning, guys. It was a good show. Hope everybody has a great day, and we look forward to talking to you again tomorrow.
The War Room is proudly presented by AgYield. For over 50 years, the AgYield team has provided grain marketing and risk management solutions for growers across the country. Our veteran consultants harness cutting-edge technologies to pinpoint risk, optimize market performance, and protect your farm's profitability. Discover a new approach to farm revenue management at agyield.com.
Hey guys, Jack here. Be sure to support the show by hitting the like button, leaving us a comment, and subscribing to the channel for all the latest updates. Thanks for watching. We'll see you next time.